Hi, it's Larry Gaines from PowerCycle Trading. In this video, I'm going to go over a strategy that you can use for trading around earnings. It's a volatility strategy, and basically all you're wanting is for a big move up or down. So it's an explosion or a movement in volatility, and you don't really have to worry about direction. So I've had a number of members ask me about different strategies to use, around earnings, and this is one of my favorites. So I'm going to go through that with you, a couple of different examples. But before I get started, if you've not received my free ebook, go here to PowerCycleTrading.com. 15 top option trading strategies, and this particular one that I'm going to go over today is in this ebook. And there's one more ebook that you'd probably like to have. Let me show you that. Now, if you're trading futures, or if you're wanting to trade futures, go to my PowerCycleTrading.com, go into this subheading free ebooks, and you'll see this trading e-minis, e-mini futures. So just put your name and address in that box there, and you'll get that right away as well. Now, there are a couple different ways to trade volatility, and what you're looking for around earnings a lot of times is an explosion either to the upside or downside. And you're not really knowing which direction it's going to go because it is earnings and they surprise. So what I usually want to look for is a potential high beta stock that can move maybe 8 to 10% or more after earnings, and also then utilize options where you're buying options that were going to expire. So you want to do this type of strategy using options that are going to expire pretty soon. So I will use weekly options as the perfect strategy for doing this. And here, the first one is really being short an iron condor, or the other one is a long strangle. The iron condor is a really good one because you can reduce your cost quite a bit. So that's what I'm going to go over. Show you a couple examples here. The first one is Apple. So Apple last week on the 23rd, had released its earnings, and the next day you can see it just cratered. It went down over 10%. It closed around 510, 513, dropped really hard, 10% and more, went down to 439 basically. So to play Apple, you could sell an iron condor, and basically what that is you're going to be what they call short the wings, long the body. And you're going to be you're going to have on an out of the money put spread and an out of the money call spread. So it's a debit spread together, combining those two. So let me show you the results. So again, shorting an iron condor, all that is your long and out of the money call spread, and then your long and out of the money put spread. So here's the call leg. So for this, looking at a 10% move, I just calculated 10% from around 510, and that put me around buying the $555 calls right here, and here's the closing price right around $295 a contract. That was on the 23rd, and then to offset part of that cost, you sell the 560 calls against it, and those were going at $225. So it's a $5 spread, and to be long this particular leg of the iron condor, that cost you 70 cents. So you 295 cost minus 225 credit you get for selling the call, and it gives you that part of the leg costing $70 a contract. Now the second part, or the second leg of the short iron condor, is basically just to be long and out of the money put spread. So on this particular one, you want to do it about the same number of strike levels that you do the call spread. So this was roughly about 10% down. So you buy the $455 puts, and to offset the cost of that, which was down here, you can see on the 23rd, those were going for $130 a contract, and then to offset that cost, you sell against it the $450 puts. Those were going at $100 a contract right here on the 23rd, and so that particular spread cost you $30. So now you've got your total cost is your cost of your call spread, $70, plus the call cost of the put spread $30. So your total cost in this, the maximum you could possibly lose, would be $100 per contract. So you defined your risk, and you're playing for volatility to spike either up or down. Now again, you see Apple here collapsed and went straight down. So you're going to lose 100% on the call spread that you're long, but you're going to make up the money on the put spread that you're long. So let me show you the results. So just to make it easy, if you took this off at the closing of the last day, which was Friday expiration, that's the other thing. These were weekly options that were put on the 23rd, and then they expired Friday the 25th. So you would have then just reversed out of this by selling the $455 puts. You would have collected $15. You would buy back the short leg, the 450 puts. You would have had to pay $12.10. So your net gain on this spread right here is $390, less your cost of $100. So on this total spread, you risk $100, and you ended up making $290 a contract. So on this particular iron condor, short iron condor, you could have made, on this particular example, $290 a contract, and that's about a 290% return. So that's a 290% return in 2 days, and you define your risk. So that's one really nice trade to trade earnings if you're looking for it. I'm going to give you one more example real quick, and this is on Netflix. So this is going to be just an example of an iron condor on Netflix. Here's Netflix, and again, its earnings came out on the 23rd after the market closed, and it was traded about $103, at that time. So let's look at an iron condor based on that. So here's your first leg. This is the $115 call, selling the $120 call. This is about 10% away from where it closed on the 23rd. And so this would have cost you buy that call, the 115 call, it costs you $210 contract. Sell against it to reduce your cost, the 120 call. So this cost you, this part of the spread was $115 a contract. And then you want to do the put spread on the other side of it, because you don't know which direction it's going to explode. So the other leg of the short iron condor is to be long a out of the money put spread. So you're long here the 90 put, short of the 85 put. This was about 10% away from where it closed, and that cost you $200 per contract to be long that $90 put, and sold the 85 against it for $95. So that's the additional cost of that spread goes to your spread as well, and that came out $105 a contract. So your total cost, when you combine the long call spread plus the long put spread, your total cost on this short iron condor was a debit of $220. Now remember, it went straight up, so you're going to lose 100% of your long put, so you've lost that, but I'll show you what you would have made based on the call. So again, this example was using weekly calls or weekly options, because you want to get this going in around expiration day so you can get your cost down. So we did weekly options, and here the 115 calls exploded to the upside, as you can see, and they closed at, you could have taken those off at $54.60 a contract. Then you'd have to buy back your short leg, the $120 calls, at $49.60 a contract. So your profit on the long call was $494 a contract, minus your cost of the whole condor was $220. So your net profit on this was $274 per contract, and your cost was $220, so that's 125% return in 2 days. So this is a way that you can do a trade strategy around earnings when you're looking for explosive moves on high beta type high volatility stocks such as Google, Apple, Priceline, Netflix. Those are some good examples. So I hope this helps you. Good luck trading, and come join us at PowerCycleTrading.com.